Okay, so for this statement, it is definitely not correct. So the first thing is that you need to know that an increase in the money supply does not affect real GDP directly, and certainly not dollar for dollar. It doesn't mean that if you want to increase the real GDP by 200 billion, you just increase the money supply by 200 billion. So it's not related and definitely not dollar for dollar. And the way the money supply can influence real GDP is through the influence on interest rate. So basically, we know that we have the market for money, and we have money demand and money supply. So in order to influence the interest rates, the Fed can change the money supply. If they want to increase the interest rate, it can decrease the money supply to achieve a higher interest rate. And if they want to achieve a lower interest rate, they would like to increase money supply to achieve a lower interest rate. Okay, so when the interest rates are lower, the households are more likely to buy new homes and automobiles, and firms are more likely to buy new factories and computers. So that's all those things are that directly influenced by lower interest rates. So the lower interest rates will be the result of a higher money supply, and lower interest rate will lead to increasing aggregate demand. So that one is closely related to real GDP. Okay, the lower interest rate also leads to lower foreign exchange rate for dollar, so which lower the price of exports and raise the price of imports. And as a result, will increase the net export of the country. So in general, it will increase the aggregate demand of the country by lower interest rates. And because the exact size of these effects is not certain, so basically, if you want to increase the money supply in the market and lower kind of interest rate, the influence of this kind of interest rate on consumption, on investment, on net export. Also, we know that those three factors could be increased based on the lower interest rate. The certain scale is not certain. We don't really know how will be the change, how will be the increase in the area demand based on this kind of lower interest rate. So basically, the fast rule is much more difficult than the statement suggests.